Remember last week's big story, the great rotation out of semiconductors? Well, to open this holiday-shortened week, the market hit the rewind button. The Dow closed at a record, and the very chips everyone was dumping on Friday turned around and led the whole market back up.
And it was memory that did the leading, which is the detail we want to sit with today. Because the most interesting money didn't just pile back into memory chips. It moved one rung up the chain to the companies that help build the memory. The smart money, you could say, went shopping for the shovel makers.
So today we'll walk the bounce, the shovel maker tell underneath it, a big bank that turned genuinely constructive, and then, fairly, the other side, a frothy, leveraged tape heading into a make-or-break data week. Quick disclaimer first. Quick, honest note before we dig in. This is just two curious people thinking out loud, for learning and for fun. It's not investment advice and never a buy or sell call, so always do your own homework.
Fast and simple. This is for education and entertainment only, not investment advice. Every company we name is a public example to illustrate the story, never a recommendation. We don't give buy or sell calls, and we don't do price targets. Please always do your own research.
Let's set the scoreboard. The Dow added about 0.6% to a fresh record, around 52,200. The S&P rose 1.2 to roughly 7430. The Nasdaq jumped over 2%. And the headline number, the Philadelphia Semiconductor Index leapt almost 3.8%.
And critically, that's a near-perfect round trip of Friday's slide. So before anyone declares a brand new uptrend, the honest read is a sharp risk-on reversal, helped along by some Middle East de-escalation relief. It's recovering ground, not minting fresh conviction.
Right. Recovered, not re-rated. The why underneath the bounce is the part that actually matters for the framework, and it starts with who led.
Under the hood, the mega caps did the heavy lifting. Tesla popped about 8.5%, Alphabet almost 5%, Amazon over 3%, Meta a couple percent, Nvidia up over 1%. So the giants that had been the funding source for last week's rotation got bought back.
And the texture is telling. One big memory name opened down around 4% and clawed all the way back to roughly flat by the close. Buyers stepping into weakness. Software firmed too. But it wasn't uniform. Healthcare ran hot, while the energy stocks actually lagged on the day, even with crude oil higher. A rotation within the rally, not a clean sweep.
And one tell from overseas keeps it honest. Korea's market, which had roughly doubled this year on the memory frenzy, actually buckled this week, down about 10% at one point and hitting limit down. Heavy retail leverage cuts both ways. So even the bullish memory story is carrying some white-knuckle volatility underneath it. Now the tell. One of the big semiconductor equipment makers, the companies that sell the machines that make the chips, reported a record quarter. Its best gross margin in 25 years, and it raised its growth guide by more than 30%.
And listen to why it raised it. High bandwidth memory, DRAM, and advanced packaging. Exactly the AI memory bottleneck we keep circling back to. The read-through was instant. Its equipment peers jumped roughly 9 to 12% right alongside it. When one shovel maker prints a record, the whole tool shed gets re-rated.
And it's not a one-quarter blip. Order books for this gear stretch out years because you can't just conjure a new tool line overnight. The lead times are long, and the expertise sits in a handful of firms. So a record here isn't only today's headline. It's a signal about demand the industry is willing to commit to well into the back half of the decade. Here's the logic, and it's the heart of today. If artificial intelligence demand forces the memory makers to expand capacity, to build new fabs, then the durable money doesn't just flow to the memory. It flows to whoever sells them the tools to build. Follow the money one rung up the ladder.
It's the pick and shovel of the pick and shovel. In the gold rush, sure, sell shovels. But the person selling the steel to the shovel factory never had to find a single nugget. That's the equipment makers, a layer removed from whose chip ultimately wins, as long as everyone has to keep building.
And that's a more durable place to stand than guessing which memory brand takes share next quarter. The framework question isn't who wins the chip war. It's who gets paid no matter who wins.
And this wasn't only price action. A major institution put its name on the story. Morgan Stanley turned outright constructive on what they're calling a memory supercycle. They're framing, artificial intelligence demand running ahead of supply all the way into 2027.
They went further, forecasting memory prices up around 30% next quarter, and, in their words, telling clients to stay constructive. To be precise, on attribution, that it's a buy line is Morgan Stanley's call, not ours. We're reporting it as a notable data point, not endorsing it.
They also noted 2026 earnings for the broad index keep beating expectations, and that even with July Federal Reserve volatility, the 6 to 12-month risk appetite still looks strong. The signal for the framework: a big institution publicly backing real, supply-constrained demand, pricing power, not a glut.
And it's worth being precise about what demand ahead of supply actually means. Nobody's claiming prices only ever go up. It's that, for now, the firms that make the memory can't add capacity fast enough to catch the AI build, which is exactly why today's reward flowed to the people who helped them add it. And the scale behind all this is genuinely hard to picture. Korea alone is reportedly running a roughly $1.3 trillion megafab program. 4 new memory plants, aiming to double output by around the end of the decade.
And memory has the pricing power to justify it. Reports peg memory prices as having roughly quadrupled over 2 years, and one big cloud provider just raised prices about 20%, passing memory costs straight through. That's not a glut. That's a supplier with leverage.
And it traces the whole chain this show keeps coming back to, from GPUs, to memory, to advanced packaging, to servers and data centers, to optical, to transformers and the power grid. Today, the market simply rewarded one specific, unglamorous link: the people who equip the factories.
And you can feel that pricing power downstream, too. Apple reportedly pushed through one of its biggest price hikes in decades, citing memory costs. Game console makers are flagging component inflation as well. When the input gets scarce, the cost ripples all the way to the gadget in your hand. And that ripple is the tell of a real bottleneck, not a passing blip.
And notice how unglamorous the winner is. Nobody's making a movie about the company that sells the polishing tool or the deposition machine. But that's exactly the point of the framework. The durable profits often hide in the boring, capital-intensive layer everyone overlooks, while the crowd argues about the flashy chatbot sitting on top of it all.
One honest footnote, so we don't overread the enthusiasm. Part of today was pure plumbing. Alphabet's near 5% jump came partly from news it's joining the Dow 30, and SpaceX popped on a coming addition to the Nasdaq 100.
Index reshuffles pull money mechanically. Funds that track the index simply have to buy, regardless of the day's mood. So on a quarter-end session like this, it's worth separating the structural story, the memory supercycle, from the calendar mechanics. Both were in the tape today. Around the edges, the macro picture. Gold slipped about 1.5% to just above $4,000, soft on a risk-on day with a strong dollar. Silver and copper eased too.
And the dollar is the thread to watch. It just logged its biggest monthly gain in about a year, and the Japanese yen sank to a 40-year low. A strong dollar is a headwind for gold, and it complicates the debasement trades. We'd frame it carefully. This is dollar strength pressuring gold, not gold's longer-term story being rewritten in a single session.
Oil firmed. West Texas back around 70.5, up nearly 2%. Two things underneath. Iran publicly denied near-term talks with the U.S., so that conflict isn't fully settled. And U.S. crude inventories sit at a 43-year low, a genuinely tight supply backdrop.
And yet, here's the rotation texture again. The energy stocks actually lagged on the day, even with crude higher. A reminder that a strong commodity and strong commodity equities don't always move in lockstep, especially on a month-end tape that's chasing the AI memory story instead.
And the supply backdrop is genuinely tight. Strategic reserves are low and inventories at multi-decade lows, so oil isn't purely a demand story right now. It's a useful reminder that risk-on isn't one switch. On any given day, the money picks its spots, and today, it simply wasn't picking energy. Okay, we've made the constructive case fairly, so now the other side, fairly, because under that record close, the tape looks frothy. Margin debt, money borrowed to buy stocks, is up 54% year-on-year to about $1.4 trillion.
And the leverage is getting exotic. Those 2 times and 3 times single stock and sector funds have roughly doubled to around 220 billion. That's a lot of borrowed, amplified money in a market where, when it reverses fast.
And breadth is thin in a way that's easy to miss under a record headline. The one-year correlation between the equal weight and the regular S&P collapsed to a record low near 79%. Translation? This is a single stock, single sector tape, not one broad, healthy rally.
And leverage at records cuts both ways. The same borrowed money that amplifies a bounce on the way up amplifies the air pocket on the way down. It's the accelerant under a fast reversal. So this isn't a doom call. It's a reason the froth matters even inside a genuinely real demand story. When the move is this leveraged and this narrow, you respect it from both directions. Add a few more honest counterweights. A couple of the Magnificent Seven giants are still down around 30% from their highs, so the index at a record story has a real hole in it. The 3 memory leaders are also facing a price-fixing class action. Low odds, but it signals how hot the pricing has run.
And the bigger question hanging over the supercycle is the earnings peak already in view? Maybe as soon as the 2027 fiscal year? Some analysts even argue this whole build is increasingly underwritten by state credit. Supportive for valuations, but it raises the stakes if the cycle turns. So it's a genuine debate. Validated demand on one side, late cycle froth on the other.
And here's a quieter cross-check on that froth. Bitcoin is actually down for a second year, and gold just got pressured by the strong dollar. When the speculative hedges and the debasement hedges are both soft, while equities print records, it hints that liquidity isn't simply flooding everywhere. The money is being selective, which is exactly what a narrow, single-sector tape looks like from the inside. And the referee for that debate arrives this week, a holiday-shortened one with the market closed Friday. Tuesday brings job openings and consumer confidence. Wednesday, the manufacturing index, expected around 53.6. And Thursday, the June jobs report, consensus near 115,000, with unemployment about 4.3.
And the two paths are clean. Goldilocks, cooling but not collapsing. The factory index holding above 50, soft wages. And the September rate hike fear keeps fading. But run hot, a factory or wage spike, and that hike snaps right back onto the table. Same prints, opposite trades.
And it helps to know what each one whispers. Tuesday's job openings and confidence are the early read on whether the labor market is cooling gently or cracking. The factory index Wednesday hides an inflation tell inside its prices paid component. And Thursday's payrolls are the headline. But on a holiday-thinned week, any surprise can push the tape around more than it really should.
So where does that leave the framework? Risk on, leaning constructive, but disciplined. The memory and AI supplier thesis just got a real institutional endorsement, and the complex is leading the market up, which is healthier than it topping out and rolling over.
But the counterweights are just as real. A frothy, heavily leveraged, thin-breadth tape, a strong dollar pressuring gold, and a week of data still pending. The grown-up takeaway isn't chase the bounce. It's let the froth settle and let the data come. The conviction is in the direction of the money, not today's candle.
Put it simply, today rewarded the suppliers and doubted the spenders. And that's been the whole season's signature. As long as the scarce inputs keep their pricing power, the supplier layer is where this framework keeps its attention. The day that bottleneck eases is the day the story changes. And we're not there yet.
So that's the day. Memory led the bounce. The smart money stepped one rung up to the equipment makers, a big bank blessed the supercycle, and a frothy tape quietly said, don't chase it. The signal we'll keep testing is the simple one. Does the money keep flowing to the scarce, hard-to-build inputs?
We don't predict. We test the theses as the evidence lands. Thanks for spending part of your day with us. Follow the working thesis and tell us in the comments, real supercycle or late cycle froth. Back tomorrow. And that's where we'll leave it for today. Thank you, genuinely, for spending part of your day thinking this through with us.
The whole idea of this show is pretty simple. We hold a handful of theses about the world, and we test them out loud, together, a little more each day. No crystal balls, just curiosity, and a willingness to be wrong.
So, if that's your kind of thing, stick around for the next one and tell us where we're getting it wrong. Honestly, the pushback is our favorite part.
Until next time, take care of yourself and keep asking good questions.